might just give you a quick trading update today, because the market is on an absolute tear down. It's taking the elevator, as they say. So I'll just show you. It's probably best just to go with this. So it's down 3.1%, which is a massive fall, and it's broken through that 7,000 point sort of psychological barrier. If you check it out on the chart, yeah, it's a huge fall, pushing down on the 90-day Bollinger Band bottom side, so it's pretty massive. If we check it on a hourly, ADX is way up at 40. So I check it on the 4 hour. Yeah, so trending up to 25. So it's pretty big. And on the 4 hour chart, it is just a continuation of that breakout. So the 200 period moving average and the 50 period moving average at a 4 hour chart, it's broken beneath that 50 barrier. Some guys build a technical, like a downtrend, if it breaks outside of the top of that. So if it's above or below that 50 moving day, or in this case 50 4-hour period moving average. So it's definitely broken above that, but it's not at its lowest point yet. If it was past here, but the ADX is just ticked over 20 on this chart. We're going to trade on a daily basis. Still got a fair way to go. So we'll see if it continues tomorrow. But this is what it's doing to the positions. So the margin has improved, but we're still sitting about where we expect. That insurance contract here on this one is doing pretty well, and it's holding up better on a monthly basis than this one is on a weekly basis. This one's doing pretty poorly. It's down $2,000. I believe it's probably as a result of that. They're set at relatively similar positions, so 6.3. I think it might be exactly the same. 6.3. Yeah. Might be just where it was opened at. The price that it was opened at was much better, a theoretical price. Sorry, the open price and the theoretical price is the calculation. So we'll see what happens. And then on the more aggressive strategy, it's actually looking good. So this is what I really like about this insurance tactic. So if I liquidated my positions right now, this account's gone up by sort of $2,700, so I could close it and effectively make $2,700. Most of that is in this June contract here. But I'd have to close the calls as well. So if I looked at the calls only, yeah, the amount that they've sort of lost in value is contributing the majority of that. So sort of $700 plus that. Less what I would lose on the puts. So if we just have a look at what I would lose on the put side for March, it's actually not as bad as I thought it would be. It's only $453. So it's tempting to do that now. Let's look at what volatility is doing. So it's pretty high. Volatility is pretty high. And usually you can get a gauge on why this might be. If you look at the market futures from Australia, you look at the futures into the US. Yeah, so that's a pretty big fall, the pre-market, but that could correct. Depends on what happens. So it went down 1.8% last night, and it's going to fall another 2.7% tonight. If we lock in all of those losses, then it's likely the market here is probably going to fall again. But you can't predict that. It might not. It could bounce. The invasion mightn't be as bad as we think. Who knows? Let's see. If this market, if it falls again tomorrow and volatility goes up by another 20%, and I simulate it as, say, 2 days from now. That's why this platform is the best. You can do this simulation stuff really fast. That is and what it says is the stress situation versus what's happening in the portfolio right now. What's really cool is you can load in strategies. So you can load in a strategy here that's with or without strategies. And you can see the difference. So simple, so easy. I really wish these guys traded US options. Yeah, so there's not a great deal of difference if I closed everything tomorrow. Well, no, there is. I'll just turn these off. 2,000. So it's gone up by, positions have improved by 2,742. If I simulate it for tomorrow, current the time decay of tomorrow plus market down another 2% plus 20% volatility increase. It's only another $800. The main thing you want to avoid in this situation is moving past that point. So really, we're a long way away from that. Like, how far away are we? Minus 8%. 8% is where it's really pushing it. If it fell 8%, I'm assuming volatility would go up by at least 50%. If that happens, theoretically go up by another $2,000. So I may as well just leave it. If the market recovers, I'll just trade it out until the end of the period, set another one. For example, if the market stays around where it is and I go to expiry, we go to expiry, I make liquidation is 2,900, but that's assuming that will go down. So I'd say, volatility would probably go back down in that situation. And then, but still, I'm better off. So either way, the market's moving down. If it moves down 8%, liquidation was around 58 grand, which is fine. Market moves down. If I can ride out to expiry, I make about the same amount and I get to keep my insurance contract and potentially even close that anyway and make some money on it. So I'll leave that for now. It's in a pretty solid spot on paper trading. This one, not as much. So we'll see. See how far it has to go. Delta's at 13. If it loses another 5%, the amount minus 9%. Yeah, it'd be sort of be down about $1,000. In that situation, I think I'd probably roll the contracts down to make the money back. This one, I'm less clear about what to do about those. But actually, it's not too, when you take out the equity value decline, most of that is the decline in the market. Cool. That's the update.